All right, folks, let me finish this up and so we can close out the day and move on. This is the chart we were looking at the end of the last video. The idea that I'm wanting to convey here is that, in my opinion, the mining stock sector is outperforming or about to outperform the broad stock market, and that in that environment, it might be reasonable to consider both dollar cost averaging and a buy and hold strategy. That's exactly what Richard Russell was telling his subscribers throughout this period, 2002 to 2011, during that bull market. And so anyway, that's the main idea in this chart. Mining stock sector is going into repricing, melt up, any number of ways to look at it. I think I've mentioned in the last video, but on a percentage basis, the amount of money invested in precious metals, much less the mining stocks, it's minuscule. That it's like 0.5%. I've seen analysts talk about if that increased to even 2%. So just 2% of the investable money supply moves into the mining sector, precious metals sector. Again, it's a repricing. Let's see, let me keep flowing or keep going here. Was there anything else? My only last thought here, let's look quick. We looked at the mining stock action on Friday. And I was just pointing out that, in my opinion, this is not a market that's getting ready to melt down. Famous last words, but, 4.8%, 5.2%, a whole series of high energy in Wheaton. There's 2.6% of Eno. Anyway, what did we get? Core was up 6.4. This, in my mind, is not a mining stock sector that's about to melt down. Now, we're only looking at 8 stocks. There's more than 2,000 mining stocks in the sector, and so eight stocks is a very small sample. And then the one last thought on this idea: institutional money managers are forced to compete with one another. And so even if they hate mining stocks with a passion, they still have to buy mining stocks if their peers are buying mining stocks. And when we have a sector rotation and money starts to flow into mining stocks, that's when that becomes relevant, because all institutional managers will be forced to participate in the mining stock rally because they can't let their peers outperform them. So that's the last of that thought. I'm going to keep moving on. We're still thinking, should we be concerned? So we're looking at what are the risks right now, and should we be concerned about those risks? This is the last risk. Demand for silver and gold could drop significantly. Well, yes, that could happen. We've had record central bank buying of gold bullion for several years now. Actually, the trend started all the way back in 2012 when the first sanctions were placed on, actually, coincidentally, Venezuela. Isn't that interesting? And so anyway, there's been a trend in place for 12 years, I guess that is, at least, of countries repatriating the gold that they've always owned but vaulted elsewhere, typically England or the United States, bringing that gold home and then buying more. And so, central banks could stop buying gold hand over fist. They could even dump everything that they bought. Well, except that Basel III just went into effect, and so now physical gold holdings are counted at 100% for banking reserves. So what's the likelihood that central banks are going to divest themselves of gold? About zero. Let's see. So this is another change. So are people going to, Anybody going to dump their physical gold? Well, this is a new trend, and specifically for silver, we've got at least one sovereign wealth fund. I believe yes, it was Russia. So Russia's sovereign wealth fund has publicly announced that they are adding silver as an asset. And then I think at least one of I think it was the Indian central bank, has announced that they are adding physical silver as a banking reserve asset. So, and then again, are people going to start dumping their metals? Well, certainly China's not. I mean, they just put export restrictions on 40 to 65% of the world's refined silver supply. And this is an important concept to understand. I've seen a number of articles in the last week or so implying that only 13% of the world's gold comes from, or excuse me, silver comes from China. That's true. That's how much of the world's silver comes out of the ground in China. Because China processes, refines, smelts silver concentrate and silver doré bars for a lot of the rest of the world, they actually end up processing 40 to 65% of the world's silver supply. And keep in mind, this is above ground silver that's already been refined and processed into 3/9 silver process. And so when people are showing their cute little articles and charts and stuff, and they're saying that China only produces 13% of the world's silver, and then they're saying, well, Mexico is typically at the top of the list, the silver in Mexico is still in the ground. It's certainly not above ground and smelted, processed into 3/9 silver products. And then, Samsung just bought 2 years of production from the La Paria mine. Does that sound like anybody of significance is going to start dumping their precious metals? They're out buying up, China's out buying up silver concentrate and doré bars directly from the mining companies. Here's Samsung going straight to not a mining company. Well, there's a mining company involved. They went straight to the mine. They bought the freaking mine. And then China, again, are people losing interest in the precious metals or gaining interest? Well, China just expanded their gold exchange, the Shanghai Gold Exchange, by opening 4 remote vaulting locations in those 4 countries. China, the Chinese yuan, the currency that everybody loved to hate, is now an international currency that's directly exchangeable for physical gold. Let that sink in, folks, when you're thinking about how concerned should we be about people dumping physical metal. In my opinion, there's no concern. Only concern, as I stated first thing this morning, the only concern is the CME playing their games with margin hikes. This is just Brian stating his opinion, folks. Silver's going to 6 1/4. Do you really care whether the reported price of silver today, whether we're talking paper price or real price, do you really care whether the price of silver today is 55 or 90? Does it really matter? Silver's going to 6 1/4. Focus on the big picture, folks. And another idea, same idea really. This is from Richard Russell, and it's an idea that he shared regularly. The bull is going to do everything he can to throw you off his back. Don't let this precious metals bull throw you off its back. This is one for the history books, folks. I'm at 9+ minutes. I covered this. This is Richard Russell's advice. When we get into an environment where the mining stock sector is outperforming the broad market, this is what he was telling his subscribers. Don't try to trade in and out of the market unless you're a skilled trader. Most likely you'll do better off with a buy and hold dollar cost averaging strategy. So just random thoughts there. I'm not going to go into this, folks, but just kind of a wrap up on the idea of hedging. Hedging, in my mind, starts when we construct our portfolio. And so one of my thoughts, if you're uncomfortable sleeping at night with your current portfolio, well, maybe you ought to examine some of your allocations. Perhaps you've got too much money in the mining stocks. I forgot to show it on there, but there's physical. I got physical metal as well. I should have had that in there as an asset category. But my point is, hedging is complicated. It starts with the construction of the portfolio itself. And again, not that it's so complex, but it's individual. It differs for every person. Running the stops, if you put stops in place on a small chart, on a small stock like GROY, likely that some whale is going to come along, run your stop, take your position. You'll be cussing the market gods, and most likely you'll never buy that position again, and you'll just miss out on GROY for the next 10 years, however long this bull market runs. But so anyway, that's something to think about in a smaller stock. In the large cap stocks, that's not so much of a concern. There are whales certainly who could run the stops in WPM, but it'd take them a lot of firepower to do so, because WIPM's a mega cap stock. Puts, that's one way to hedge, but they become expensive. So like right now, the volatility in the metals and the miners has made puts very expensive. And so, does it make sense to hedge with puts? The leveraged bear ETFs, that's a possibility I haven't looked at yet. But anyway, folks, I just wanted to share some of my ideas about hedging on this particular bull market. Here's my two key thoughts, and I'm going to finish. Don't get thrown off the bull, folks, please. Not that it really matters to me, but it'll matter to you. Don't get thrown off the bull. And then again, silver's going way higher, as is gold. What are you worried about? Talk to you soon, folks.